This is Al Brooks, and this is my price action trading course. This module has to do with trend types. So how do we trade trends? I have a series of modules later on that goes into detail about that. The strongest types of trends, they provide the best opportunity for a big profit. However, they're often scary for beginners because a lot of times there are very big bars. Big bars mean fast market and not enough time to make decisions, and they also mean the stop is further away, so the risk is bigger. Beginners are always wanting a smaller stop than what is required in a strong trend. They're waiting for a pullback, and the pullback doesn't come for 1 bar, 2 bars, 5 bars, 10 bars, and the trend just keeps going on and on and on. And before beginners realize it, that they've missed most of the trend and most of the profit because they were so determined to wait for a pullback where they could use a tighter stop. Once there finally is a pullback, the setup is usually less clear. It's more uncertain, and the pullback begins to look like a reversal to a beginner. And the pullbacks are small and not convincing. It doesn't look like the trend will resume, but it does. The signal bars are often weak in a pullback in a strong trend, so the beginners choose not to take the pullback trade, so they miss the pullback entry as well, and they continue to wait as the trend continues onward. And then the beginners finally decide they're ready to take the trade, and they're thinking, okay, I missed the breakout, I missed a lot of the channel, this is going on too far too fast, it can't go on forever, it's got to go the other direction pretty soon, it's got to be way overdone, this has got to be a climax. So they bet on a regression to the mean, that the trend has gone far enough. So why not try to pick reversals since the risk is small? If you have a bull trend and a bear reversal bar, you short below, you put your stop above, and you're only risking the height of 1 bar. Sounds like a great way to trade. What they forget, or what they don't realize, is that trends have inertia, and 80% of reversal attempts will fail. And they don't realize how low the probability is for their reversal trade. So they end up losing money on a huge trend day, a day when they should have made a lot of money, because they started taking reversal trades that have very little probability of success. Reward probably no bigger than the risk, and therefore a terrible trader's equation. Trends offer a great opportunity to make profit, but you have to understand how they operate, and one good way to understand is to classify them into different types based upon how they behave. All trends begin with a spike. You can call it a trend bar, you can call it a series of trend bars, you can call it a breakout, you can call it a strong trend. I usually refer to it as a spike. Eventually the trend starts to have pullbacks and it enters a channel. As time goes on, the channel gets flatter and broader and it evolves into a trading range. The momentum in the opposite direction increases, and you can start taking trades in both directions. And if the trading range goes on long enough, traders are uncertain whether the direction of the breakout will be up or down. And eventually you get that breakout up or down, and then the market cycle begins all over again with a new spike, then a new channel, and then a new trading range. All trends contain both a spike and a channel. The spike is the breakout. The two words mean exactly the same thing. And it also is, to me, it's also a strong trend. And you can see the module on breakouts and also the modules on trading breakouts. A channel is a weaker phase of the trend, and there's some two-sided trading going on. There are some pullbacks. For example, if you have a bull trend, you'll occasionally have pullbacks, and during the pullbacks the bears will be in control at least for a bar or two. Most strong trends begin with big breakouts, like a gap on the open and then 1 or 2 more big trend bars, or there can be a series of consecutive big trend bars. What constitutes a strong trend bar? A bar with a big body and small tails. So for example, a big bear trend bar closing on its low tick with no tail on the bottom. Here's an example. Spikes can be very, very big. Here's a 2-bar spike, but it's also a continuation of the gap up. So the actual spike is the gap plus these 2 bars. And then we have another spike here, another spike here, another spike here. This channel, it's actually in a channel at this point because we're getting some overlap, some little pullbacks, but the channel is so strong that you know it has to be a spike on a higher time frame chart. This is a 5-minute chart, and if you look at a 15-minute chart, you will not see a spike and channel. You'll just see one spike composed of a series of bull trend bars. Within the channel, there are smaller spikes and then other channels. Here, 2 bull trend bars, both large, closing near their highs. That's a sign of a strong trend. Look at this trading range, a quiet trading range for all of the day, and then at 9:30 there was a report, an FOMC report, and look at this bar, a huge bar, rallying almost 1% in just a matter of minutes. It's about 10 times bigger than the prior bars. That's a very significant bull trend bar. Even with the tail on top, it's still a huge bull body. So this is a huge bull breakout. And this is what followed, an unbelievably large trend. The market went up several percent over the course of the next couple of hours. So a huge breakout can be followed by a huge trend. A huge trend can begin with a small spike. You know, if the context is right for a trend, you can have a single unremarkable trend bar leading to the start of the trend. And it can be followed by a channel that can go on for 30 or more bars without much of a pullback. And the channel can accelerate as the trend goes on and then have a strong breakout. So sometimes the channel can accelerate into a parabolic curve. Here's a huge bull spike and a channel, and then we're trying to break out again. So we're getting a bull breakout of a bull channel. Most of the time that fails. Here's the failed breakout bar. So we have the bull breakout, and then we have the bear bar, which is the failed breakout bar. At this point, it looks like we're probably going to form a pullback, and the trend will probably resume. However, you have to pay attention. You got a bear bar here, and you have a bear bar here, trend bar. Decent sized bars, especially this one closing near its low. You always have to keep the thought in your mind that, you know, it's a bear spike. It's possible that this will lead to a bear trend and that this was an exhaustive buy climax. Probably not. The odds are this is probably going to end up being a failed attempt by the bears and a bull flag and another buy. But you have to be open to the possibility that this little bear trend bar, or maybe this little bear trend bar, will be followed by a bear channel that'll go on much longer than what you think is realistic. And that's what actually happened here. So we had a bear spike here, another bear spike here, and a big channel. Another bear spike, and then a wedge-shaped channel down here. Another bear spike and a wedge channel here. So you have a spike down here and a channel, a spike down here and a channel, spike down here and a channel, spike down here and a channel. It doesn't have to be textbook. You don't have to have a spike and then a perfect channel right away. You can have several spikes. You can have channels that can be drawn different ways. I could have drawn this as a micro channel. Instead, I drew it as a wedge channel. I could have started the channel with this bar instead of up here. I could have drawn it very tight just over these bars as a micro channel. The point is, anytime you see a bear spike and the context is supportive of a possible bear trend, here an exhaustive buy climax, you have to be aware of that possibility and be ready to take shorts if a trend follows. Here's another way to view that same chart. You can refer to this as the spike and then this as the channel. It doesn't matter which bars you use to create the channel. It doesn't matter how you draw the channel. It doesn't matter which spikes you use for the spikes. You just simply have to understand that the market is in a bear trend. It's channeling down, no matter how you draw the channel. There are nested patterns within patterns. Here's a spike and a micro channel, another spike channel. You just don't want to lose sight of the big picture. The big picture is it's a bear trend. Here's another example, a 2-bar bear spike within a trading range. And it could simply be a cell vacuum test of the bottom of the range. We had that over here. We had it over here. Less so over here. This could be simply another version of it. But anytime you see a bear spike, you always have to be thinking that it could be the start of a bear trend, and it could be followed by a channel. And here it was. We have another bear spike and a tight channel. This channel became parabolic. If you draw lines connecting the lows, the lines became increasingly steep. So this is a parabolic sell climax. Usually this leads to a pretty sharp rally. Let's say you have a channel that's extremely tight and you cannot tell if it's a spike or a channel. It doesn't matter. Assume that it's a breakout, a spike, and trade it like a breakout. Even if it's a channel, you still trade it like a spike. If you can't tell whether it's a spike or a channel, assume it's a spike, trade it like a spike. And you can look at the module on trading strong trends. It talks about how to trade breakouts. When a channel is very tight, it's still a weak trend compared to a breakout. Remember, a trend is either weak or strong. A strong trend is a breakout. A weak trend is synonymous with a channel. But sometimes channels can be very vertical and very tight, very small pullbacks, and essentially a spike. And they usually are spikes on higher time frame charts. And when you have a channel that is so strong that it's almost as strong as a breakout, you trade it like a breakout. And you only take trades in the direction of the trend, and you try to swing. Here's an example of a gap and a spike. So here's a bull spike in green, and then a channel. But the channel is very tight, very small pullbacks. You certainly would not be looking to short. You would treat this like a very strong trend, even though technically it's a channel and therefore weak compared to a breakout. The slope is less than that of the breakout. But when it's this strong, it's going to be a spike on a higher time frame chart, and I would treat it like a spike and trade it like a spike. Okay, here's an example, a gap and a spike. So this is the spike is the gap opening plus this bull trend bar. And then we had a channel. But the channel has very small pullbacks, and the channel is very tight. This kind of a channel almost certainly is a spike on a higher time frame chart. Here's the identical chart on the 15 minutes. This pink box is the gap, and then here is the 5-minute channel. Here's the 5-minute channel over here, and this is what it looks like on the 15-minute chart. A very strong bull spike. So when you see a 5-minute channel that is very tight, trade it like a spike, because you know that it's a spike on a higher time frame chart. On the other hand, when a channel is very broad with big swings and it's not very vertical, it's almost flat, it's very much like a trading range that has a slight slope. Trade it like a trading range. Take trades in both directions, and like with all trading ranges, buy low, sell high, and scalp. For trading broad channels, you can see the modules on trading weak channels. And you can also see the modules on trading within trading ranges. Here's an example of a very strong bull spike, but it's followed by a channel that has pretty deep pullbacks. The channel is pretty flat and pretty broad. So it's a broad bull channel or a pretty weak channel. You can take trades in both directions when a channel has swings that are this deep. You should make sure that you buy the pullbacks. It's less important to sell the rallies. Remember, we have a spike, a bull spike, so it's a bull trend. We have a bull channel, higher lows, higher highs, it's a bull trend. So you want to make sure to take the longs. You don't have to take the shorts, but if you're aggressive and good at scalping, you can. So if you have a bull channel, is it weak or strong? Is it very tight and very vertical? Or does it have big swings? Or is it something in between? It doesn't matter. Sometimes it's impossible to tell how weak or how strong it is. When in doubt, remember it's a bull channel, which means it's a bull trend. Only take the trades in the direction of the trend. So in the example that I just showed, only look to buy. So why classify the trends into different types? Because there are different types and they don't behave the same way. And different trends offer different kinds of opportunities for trading. The one thing they have in common is once you decide that it's a trend, try to swing most of your position. Here are the lists of types of trends as I categorize them. Spike and channel. Every trend that you see has a spike and channel component to it. So you see spike and channel trends every day at some point. A trend from the open, in other words, from the very first bar or very first few bars of the day, the market trends for the rest of the day. That happens about once a week. Trending trading range days, where the market's in a trading range, and then it breaks out, and then it forms another trading range. Sometimes it breaks out again and forms a third or fourth. They're pretty common. Very clear ones occur a couple times a week. Trend resumption day, for example, if the market sold off and then went sideways for 4 hours and then sold off again, that's trend resumption. You get those, I have it down here once a month. The textbook perfect ones are about once a month, but different versions of it are more common than that. And then broad channel trends, including broad wedges and stair patterns. In some form they occur maybe once a week. And then a small pullback trend, where the trend is trending all day long and the pullbacks are tiny. The move is not going up very fast or going down in a bear trend, but the pullbacks are very, very small. This is the strongest type of trend, and you get it about once a month. Every type of trend usually can be classified as another type as well, but usually one type of behavior is dominant. For example, every type of trend has at least one spike and channel in it, but if other characteristics are more prominent, I would classify it as another type and trade it like the other type. Here's a spike and channel bull. The red box is the spike, and the spike subdivided into a couple of smaller spikes. And then we had a channel, and there was a small channel in here and a bigger channel. Big picture, the red box, spike, blue channel, and the blue channel with other patterns within. But this is a typical spike and channel day. A strong bull spike and then a channel for the rest of the day. Trends tend to trap traders. Once you think a bull trend is likely, don't get trapped into shorts. Don't keep looking to pick tops, and don't get trapped out of longs. Every time you see a little reversal, don't assume it'll succeed and exit your longs. Once you think there's a bear trend, don't get trapped into longs. Don't be bottom picking, and don't get trapped out of shorts. Every little reversal looks like it's going to be the end of the trend. Don't get out of your swing shorts, because those reversals, 80% of them will simply go for a few bars and become a bear flag. Again, here's that spike and channel trend. Once you decide it's probably a bull trend, don't get trapped out of longs every time you see the market trying to correct. Assume that every one of those corrections will fail and that the market will resume up. And not only don't get trapped out of longs, don't get trapped into shorts. Don't be thinking, this looks like a great top, I'm going to short this. It's still a bull trend until it's clearly not. And to me, there's no evidence anywhere in this channel that the trend is ending. So don't short. All channels evolve into trading ranges. the channel usually eventually reverses, and the market then comes back to test the beginning of the channel, and at that point you're no longer in a trend and no longer in a channel. You are now in a trading range. So for example, this is the monthly E-mini futures contract. We have a strong spike up and then a channel. Anytime you see a channel, a bull channel, you assume it's a bear flag and that it will be followed by a trading range. At some point you'll look at this and say, oh, it's part of a trading range. And the market usually comes back to test the beginning of the channel. It can bounce there and the trend can resume. We can go sideways into a trading range, or the market can reverse. And that's what happened here. Here's the spider, same chart. Spider is the ETF, spike and channel. We came down and we fell strongly through the bottom of the channel. So you have a bull channel evolving into a trading range, and in fact, instead of just a trading range, it turned into a bear trend. Okay, here are a collection of spike and channels. Every blue box is a spike, and followed by a channel. So we have a bull spike and a channel. A channel evolves into a trading range. And look at the chart. Okay? After this bull spike, the market has been in a trading range. So if you only looked at this point, you'd say, wow, it's a bull trend. We have a spike and a bull channel. Yes, but you have to assume that this bull channel will eventually become part of a trading range. At this point, if you don't see the bars to the right, all you see is a bull trend, a spike and channel up. But that channel probably is also the start of a trading range. Once you have the entire chart, you can see that this is part of a trading range. If you ask to draw the trading range on this chart, it's all the way back here to bar 4, right? And it includes that channel. So even though this channel was part of a bull trend, it ended up as part of a trading range. Market came down, tested over here, tested the bottom of the channel. We have a spike down, wedge channel down, and the market rallied and tested the top of the channel. Here we have a channel up where the lines are parallel instead of wedge shaped as they were on the two prior channels. Within every pattern there are smaller patterns, there are nested patterns. So within this wedge shaped channel there are spikes down and channels down, there are smaller spikes up and channels up. And it's just very common to see smaller patterns nested inside of larger patterns. And if you go to higher time frame charts, whatever you're seeing on the chart in front of you is nested inside some even larger pattern. Okay, this is a particular type of spike and channel. If you look at the cash index, you can see the spike down and then a channel. On the S&P futures, you don't have a trend bar here, you have a gap. Remember, every trend bar is a gap, every gap is a trend bar. So this gap is effectively a trend bar and a spike. So this is a gap spike and channel type of trend. It's just a different version of a spike and channel trend. Now, a trend from the open. This is often a strong type of trend. Within the first few bars of the day, sometimes the very first bar of the day, the market forms either the high or low of the opening trend. The market often forms a trend in the first hour or two, and sometimes the high or low of that trend can begin with the very first bar, and sometimes it remains the extreme of the day for the entire day. And it's a sign of urgency. For example, if the first bar is a strong bull trend bar and the market keeps trending up all day, that's a sign of urgency and usually a sign of a very strong bull trend. Sometimes it can become a trading range, but most of the time when you have a trend from the open, it's a reasonably strong trend. Here's an example. Yesterday there was a very strong bull close and we gapped up, but the first bar of today was a big bear reversal bar closing on its low. It's a good swing short for sure, and it turns out that it was the high of the day. First bar of the day often tells what the day will be. Here we have a very big bear trend bar, and it was followed by a very big trend day. This is also, it's a trend from the open, right? The first bar of the day was the high of the day, so it's a trend from the open bear, but it's also an example of a trend resumption bear. We trended down for the first couple of hours. We went sideways for a few hours, and then we had a second trend down. So a leg 1 equals leg 2 move. Here's leg 1, and then sideways, and leg 2 fell for about the same number of points as occurred during leg 1. And within this channel, there's also a spike and channel. All days have spike and channels, all trend days. In fact, all days have spike and channels occurring at some point during the day. Here's an example of a trend from the open bull. The trend began on the third bar of the day. The third bar of the day was the low of the day, but then we had a very strong trend up from there. A bull spike up through here, another spike here, and then a channel. Several different things that you can call spikes that led to the different channels. Another example of a trend from the open bear. Okay, not a good signal bar for the bears. You're within a trading range and you have a bar with a small body and big tails, so the day might be a trading range day. However, it trended down from the very first bar. Traders would probably start shorting somewhere in here, a low 2 short, after trading down for 7 or 8 bars, and then a double top, so another short. Wedge bull flag, 3 pushes up, 1, 2, 3. Second entry, moving average gap bar. The low of this bar is above the moving average, so it's a gap bar in a bear trend, usually a short. 3 bars up, okay to wait for a second entry. Here's the second entry short. Here, a bull spike and 3 pushes. So this could be effectively a 3 push pattern or a wedge pattern, so also a good short. Here, a low 2 short. The market went up and then down, and then another bull body up at the moving average, so it's a short below the low. A bear micro channel after a very strong bear spike. The reversal up will probably fail, so it's okay to short this as a low 1 short. A trend from the open can be one of the very strongest type of trend days. This is also a trend resumption day. There was a bear trend, a trading range, and then a resumption of the bear trend. Okay, low of the day on the very first bar, so a trend from the open bull, very strong spike, pretty weak channel, lots of overlap, small bodies, a lot of tails, and the day ended up as a trading range. So even though it's a trend from the open bull, and the close of the day was above the open of the day, so the daily chart had a bull bar, a bull body. It was basically a trading range day. You get rid of these 2 bull bars, and all the rest of the day was just sideways. Okay, variations. Every pattern has smaller patterns within it, and every pattern is part of a larger pattern. So if you see a pattern on a 5-minute chart, and then you look at a 15-minute chart or a 60-minute chart, you'll see that whatever you're looking at is actually a small part of something that's much larger. The markets are fractally related. They're basically the same patterns on all time frames. Now, what about a trending trading range day? A fairly common type of trend day. The market will form a trading range for the first hour, 2 or 3, and then it breaks out. Usually not a big breakout, usually 1, 2, or 3 bars, and then it enters another trading range. Less often, there'll be a 3rd or 4th breakout and trading range. Here's a good example. The market was mostly sideways for the first hour and a half, and then a 2-bar bear breakout, and then it was sideways for another 4 hours. So this is an example of a trending trading range day. Very common for the market to try to reverse back up into the upper trading range later in the day. In fact, all reversal days, not all, most reversal days come from some kind of trading range, and most reversal days come from trending trading range days. I mentioned trend resumption a couple of times. Very often the market will have a trend in the morning and then sideways for midday. At the end of the day, 2 things can happen. The trend can resume, so you get, for example, in a bear trend, you can have a down move, sideways, and another down move. You can get trend resumption. Alternatively, you can have a trend down, sideways, and then a trend up. You can get a reversal. So if you have a trading range leading to a reversal, the day becomes a reversal day. And most reversal days, as I said, begin as trending trading range days. So whenever you have a trending trading range day, you have to be aware that it could end up as a reversal day. So you have to be ready for a breakout in either direction, either into a resumption of the earlier trend or a reversal of the earlier trend. Here's an example. The market sold off and then went sideways, and traders did not know whether we would get a resumption of the earlier trend and more selling or a reversal. Here's an example of a trending trading range day. The market was in a trading range and then a lower trading range, and the day became a reversal day. The close of the day well above the open, and this sell-off became a tail on the bottom of the bar on the daily chart. Here's an example of a bear trend and then a trading range, and instead of a reversal up, we got a resumption of the bear trend. Broad channel trends, okay, this is another type of trend, and sometimes it's unclear whether the market's in a trading range or in a weak trend. Whenever you're not sure whether the market has begun a channel or whether it's still in a trading range, trade it like a trading range. Buy low, sell high, and scalp. At some point, if it is a broad channel, and it's still within a trading range, you'll start to see trending highs and lows, and the trend will become clear even though the market's still in a trading range. Once you feel that the market has clearly become a trend, it's good to start swinging part of your position even if you're still within the trading range. You can still choose to scalp until the trend becomes strong. Here's an example of a broad channel trend. We have a spike up and big swings up and down. You certainly should try to take the longs because it's a bull trend, right? A bull channel is a bull trend, so you want to be taking the longs. And you could consider shorts if there was a strong enough setup. Selling is optional. Here's the daily spider chart. We have a high, a couple highs here, a higher high, another higher high, another higher high. We have a low, a higher low, a higher low. You can look at this through here and say the market's in a trading range. It is, but you're also getting higher highs and higher lows, so it might also be a bull channel. And in fact, that's what it was doing. So you could swing longs on any of these pullbacks, or you could continue to scalp. If you do buy, you want to be buying near the bottom of the channel. Here's a potential. After you have these three pushes up, you can create a trend channel line and drag it down below and anchor it to this first low, and then look to buy when the market comes back to the neighborhood of that lower line, especially if there's a reversal up. And once it starts to turn up, you put your stop below the most recent higher low. There's a special type of broad channel trend called shrinking stairs. Not too important, but I'll mention it anyway. You get a series of breakouts. So for example, in a bull trend, you'll have a swing up and then a pause, another swing up and another pause, and another breakout, but each breakout is smaller and smaller and smaller. So the market's stair-stepping up, but the stairs are shrinking. It's a sign of loss of momentum. And once it's clear that the market's in a shrinking stairs pattern, you can start fading breakouts, looking for a test of the breakout point. For example, let's say you're in a bear shrinking stairs pattern, and the last breakout reversed up after falling 10 ticks below the breakout point. The next time the market breaks to a new low, place a buy limit order at 7 ticks below the prior low, looking for a bounce up back to the most recent swing low. So here's an example. Each pink box is the size of the breakout. So here's the breakout point, here's the end of the breakout. The market broke below here and it fell down to the bottom of the pink box. So possible shrinking stairs. So traders will look to buy below this next bar, looking for the breakout to be less than the size of this one, and their minimum target would be a pullback back to that low. So enough room for a scalp. This is actually a very, very big move, and there are a lot of points in here, so there's enough room for a couple points scalp up. And you could usually hold for a test all the way up to the moving average. And a small pullback trend day, I mentioned that it's the strongest type of trend day. It's often another type of trend day as well. Very often it's a trend from the open trend. There's usually a spike in channel component to it, and there are usually small trading ranges within it, so it's usually often a small, a trending trading range day with several small trading ranges. It usually begins in the first hour or two, and the pullbacks are all pretty small, less than twice the size of an average bar. Usually after 11 o'clock or 11:30, you get a pullback that is 50% to 100% bigger than the prior pullback, and then a resumption in the close. So let's say you had a bear small pullback trend day, and the biggest pullback was 2 points. You'd look for one 50% or 100% bigger toward the end of the day. So instead of 2 points, you look for a 3 or 4 point pullback later in the day, a 3 or 4 point rally, and you look to short that, expecting a resumption into the close, resumption of the bear into the close. Strongest type of trend day, small pullback day. Look how big the pullback is. Very, very tiny. All right, very small pullbacks all day long, and usually there is a pullback later in the day that's 50% or twice as big as the prior pullbacks. Here, that pullback occurred at the very end of the day, so there was no time left to buy it. The setups never look all that good. Look at the signal bars. You know, they just don't look all that good. The pullbacks are too small to allow making any money on shorts, so you should only be buying, and you should be buying all day long. This is what I was talking about in terms of the late pullback being 50% to 100% bigger than the prior pullbacks. Okay, small pullback trend day. Look how tiny the pullbacks are. You know, just a few ticks. Okay, through this point in the day, the biggest pullback was here, 26 ticks. So at some point in the day, I would expect a pullback about 50% bigger, so 39 ticks or more. And if we do get that pullback, I would look to buy it for a new high of the day. Here we had a pullback 42 ticks and 3 little pushes down, 1, 2, 3, and a bull reversal bar. To me, that's a reasonable buy for a breakout to a new high of the day into the close of the day. And that's what happened. We had the move up, but at the high of the day, we got a reversal bar, a bull body, but closed below the midpoint, so it's still a reversal bar. And this might be evolving into a trading range. So to me, I would not get greedy. If I did not take profits at the new high, I would get out below the low of this reversal bar, because the market may be evolving into a trading range. Here is a small pullback bull trend day. It's also a spike in channel. So we have a spike and a channel, and it's a strong trend. So you got to be looking to buy. And we have a bigger pullback later in the day. This is the same chart that I just showed. So you try to buy the bigger pullback, looking for a new high of the day. Here's a small pullback bear trend day. Again, the strongest type of day. Look how tiny the pullbacks are. You got a new low, but look how little the market rallies. But look at the sell setups. Here we got a bull bar and a bull bar here, a bull bar here. You know, those are not strong signal bars. Look at here, you got a doji, another doji signal bar. You got a bull bar, right? The setups never look good enough, and that makes a lot of traders not take the shorts. So they get trapped out of a very strong bear trend day. You know, they keep waiting for a bigger pullback that looks like it'll be safer, They keep waiting for great-looking bear reversal bars for signal bars. You're not going to get them. And a small pullback trend day, this is how they typically look. The pullbacks never look like they're big enough to short, and the signal bars never look good enough to short, but you got to take them. And that is the end of my module on the types of trends.